Now for today's sponsor, Rogue Energy. If you love energy or if you love hydration, Rogue Energy is your one-stop shop. I personally love to use the energy supplement as it helps me focus when I work, and it also helps me power through workouts when I go to the gym. I also love to use the hydration whenever I go out for a run or do any type of cardio activity. It really helps me replace my lost electrolytes. Make sure to use my code Harariboy at checkout for 10% off your purchase. What's up, everybody? Welcome to episode 4 of the Harariboy Podcast. I'm your host, Harariboy. We have a whole slew of topics to cover, so let's get into it. Alright, so the agenda for today's episode, we're going to go over why you should be investing today, the correlation between marriage and money, micropreneurship, alternatives to getting a degree, and we're going to go over an example of people living paycheck to paycheck on a 6-figure salary. So stay tuned for all of that. Alright, so for our first topic here, why you should invest today. The S&P 500, it is reported that it's about to hit an all-time high this year. And if that happens, that's usually a good economic indicator for a great economic year, according to economists and past performance indicators. Let's go ahead and watch this video, and we'll go ahead and react.
Brought to you by the EveryDollar app. Start budgeting for free today. Let's catch up a little bit. There is a company called Standard & Poor. They are one of the companies that rates things on the stock market. The most famous thing that they rate, there's a company called Dow Jones that has an average of the industrial companies, which creates the Dow Jones Industrial Average, which is a little strange because a lot of the companies are not industrial anymore that are part of that average.
An old-timey term.
But it comes from the, when America was more manufacturing driven than it is today. The S&P, Standard & Poor, rates the largest 500 companies that are publicly traded, meaning their stock is sold on what we call the big board, the New York Stock Exchange. So these are the largest 500 companies that sell stock in America. And that means as this group of companies goes, is a good indication of what the economy is doing. It's a good indication, certainly, of what the stock market is doing, because basically they make up the vast majority of the stock market. So the top 500 companies on the New York Stock Exchange is called the S&P, Standard & Poor S&P 500. Now, that's important because that's actually a better way of measuring what the stock market is doing than the Dow is. Okay, or the Dow Jones Industrial Average, or any other measure for that matter. This is a very generic measure, and people in the financial world use the S&P 500 as a plumb line to tell what the market is doing. So if a mutual fund, for instance, outperforms the S&P 500, that means the mutual fund is making better returns than the market as a whole. If it underperforms the S&P 500, it makes less returns. So all that's important. Nice article, James, our producer, pulled up for us. If the S&P 500 hits a new all-time high in 24, you can expect a strong year of gains to follow, according to Ned Davis Research. The investment firm crunched the numbers and found that when the S&P 500 hits at least one record high in a given year, that year's median return is about 15%. So what they're saying is that when the stock market tops out and has a new record, that is almost always a year that you get great returns. Well, duh. Obviously, if the stock market's hitting a new record, you ought to be getting great returns. It kind of makes sense, right? So
good foreshadowing, guys.
Yeah, but I mean, it makes sense.
That's encouraging.
It's an interesting. It is a valid statistical correlation. So I like the study. The S&P 500 has tended to post double-digit gains in years with record highs. Ned Davis Research said the data point highlights two typical characteristics of the stock market: that strength begets more strength, and that stocks don't typically crash from all-time highs. So just because it goes way up generally means it's going to go up. It doesn't mean it's going to go right back down. And that makes sense, of course, too. Of course, this stat is not a slam dunk. The S&P is less than 2% away from hitting a new all-time high. If it were to do that in the next day or two or the next month or two, then the historical data indicates that you're going to have a great year, which also makes sense because it wouldn't have hit a high if it hadn't moved towards a great year. But it doesn't just jump up there and then jump down. So all this to say, we're close to hitting a new record ever in the history of the stock market, up. And if it hits that, that is a great indicator that 24 is going to be a great year to have invested, which means that if you're waiting until after the presidential election in November to do your investing, that's probably a dumb idea. If you got some money you're sitting on right now, I would buy your mutual fund like tomorrow, right now.
And if you're thinking about pulling all your money out because you saw some headlines, don't do that either.
Yeah.
We found that if you just ride this roller coaster over time, you're going to hit a new record high and a new record high. And then
it's going to go down. And then it's going to come up. And then it's going to go down. And then it's going to come up. This is how life works. I mean, it's how the real estate market works. It's how mutual funds work. It's how the whole, stock market works. The S&P 500, all this does that. So here's the deal. You got $100,000 and you wait till November and this market hits and does what this study indicates, and let's say it makes 15%, which was the average, the median, okay? So $100,000 and you don't invest it, you wait till November, and the market goes up 15%. What'd you lose? $15,000. Because you didn't do what I just said to do, invest. So you stock, and let me just tell you, real estate's exactly the same place right now. Is real estate going to go down? No, it's not. We have a tremendous shortage of housing. There's more buyers, even in a sluggish, slow market where people are sitting on the sidelines because interest rates spiked up. Now they're coming back down. They're coming off the sidelines in the last 2 weeks like never before. But if you wait a year to buy a house because you're somehow waiting to time the market, you've got this mysterious insight that you think things are going to go down, you're wrong. And if you wait a year to invest in the market because you're waiting on the market to come down, you're going to miss it. And if I'm wrong, give it another 12 months and I won't be wrong because it'll come up. I mean, really. So I got to tell you, what is Dave Ramsey doing right now? Buying. Period. Investing. Period. I'm not waiting on the clash of the old men, Trump and Biden. I'm not waiting on two 80-year-olds to have an MMA to decide what I'm going to do. Because who the crap knows? One of them may break a hip.
Well, it's more like bumper cars that are running out of battery bumping into each other more than a clash.
It's like two Muppets. The old men Muppets, right? So
Statler and Waldorf, is that them?
That's him.
Oh, my gosh.
So you don't wait on this. Don't watch Fox News and CNN and let your butt sit on the bench. Get in the game. Shoot the ball. Fire. Pull the trigger. Whatever metaphor we need to use to cause you to actually do the investing.
Sports, weaponry, whatever it takes.
Whatever it takes to get you moving here. We'll go whichever direction you need to go.
And this validates a lot of what you've been saying for 30 years, Dave. We looked at historical data, and the S&P 500 average annual return is 10 to 12%. And they're saying right here, this is could be a year about 15% median return. And people always go, well, Dave, I'm not getting that in my account. Well, yeah, dummy, not in a given 1 month period will you see that, but over time, the average is 12%.
The average.
That's how averages work.
Averages.
I think we all need to go back to basic math.
Statistical. Yeah, these sixth grade math classes that people flunked. But yeah, that's the thing. So all of this to say, boys and girls, please be steadily investing. Please. The people that invest are the ones that have money. There's a high correlation between people who save money, invest money, that have money. Hello. Why was that deep? If you don't put any money in the account, please don't expect any money to be in the account. Why is that hard?
Well,
but just keep doing it. Just keep doing it.
I think there's a lot of fear, and it's why I love working with a financial pro, SmartVestor Pro. Great person to work with, to reach out to a financial advisor or an investment pro and go, help me understand this, and you make the decisions. and they're not going to pull the money out for you. You are calling the shots here, and they're going to help you understand the perspective that we're showing you on the show today.
Yeah, you can pull up the historical data and look at the track records, look at the trend lines. It's really not hard to understand. I mean, it's really not. I mean, if you pull up in a neighborhood and there's cars up on blocks and the gutters are falling off the houses and the place, everything you see needs weed eaters, then you know, and then you pull up the MLS data on that neighborhood and you see the values have been going down, it doesn't require rocket surgery to figure out that this thing's going down in value. I mean, you know, it's just not hard. And if you pull up in the neighborhood and everything's manicured and it looks like freaking Leave It to Beaver lives there, you know, and you go pull up MLS data on that, you're going to see a line up and to the right. Hello. Well, it doesn't take a rocket surgeon to figure that out either. Go buy a house in that neighborhood. These are trend lines. It's historical data. You can watch this stuff.
So do you have a minute to connect? Let's Minect. That's right, guys. I'm officially on Minect now. You guys can go ahead and book me. I will be offering financial as well as career coaching based off of the Dave Ramsey principles, of course. So yeah, feel free to contact me, connect with me on Minect, and I look forward to speaking with each and every single one of you. Alright, so you saw what he had to say there. Basically, the moral of the story is follow the principles I laid out in my previous video episode. Basically, we went over how to allocate the percentages for the mutual funds and how to invest in mutual funds as a whole. Also, you never want to jump off of a roller coaster as it goes down. So the stock market is going up and down at all times, and those who jump off way too early lose out on all of the gains. So my recommendation is to always buy and hold long term. So get in now. Don't wait until November, like Dave Ramsey said. You don't want to, wait till the end of the year. Start now. Start as little as you can afford, and you'll be surprised at how much you can get out of it. Also, guys, make sure to check out my merch. I do a new merch drop every single month, so link is in the description below. Go ahead and check that out.